So, you've been hearing about options trading everywhere, on the news, from friends, maybe even from your favorite influencer. It seems like everyone is getting in on it, and it sounds like a great way to make money in the stock market. But it's confusing, right? Terms like calls, puts, and strike prices leave you scratching your head. Well, you're not alone. Trading options can seem like a daunting puzzle, but once you understand the basics, you'll see that it's a powerful tool that can open up exciting new possibilities for your investment strategy. In this video, we're going to break it down step by step, simplifying the concepts of options trading and making them easier to understand. By the end, you'll know exactly how options work, the different types of options, and how to start trading them like a pro. Let's dive right in. What are options? At its core, an option is a financial contract that allows you, the trader, to buy or sell an underlying asset, like stocks, at a predetermined price within a certain time period. Think of it like making a deal with someone. You're agreeing to buy or sell something at a specific price, but you don't have to if you don't want to. Options are similar to placing a bet on whether a stock's price will go up or down in the future. The beauty of options is that they give you the ability to control a large amount of stock with just a small initial investment. This can result in huge profits, but also, of course, significant risks. There are two main types of options, calls and puts. Understanding these is crucial for getting started in options trading. So let's go into each one. Call options, the right to buy. A call option gives the buyer the right, but not the obligation, to buy a stock at a specified price, called the strike price, before the option expires. You buy a call option if you believe the stock's price is going to go up. Let's say you're eyeing a stock that's currently priced at $50, but you think it's going to rise over the next month. You could buy a call option that allows you to purchase the stock at $50 anytime before the option expires. If the stock price does rise, say, to $60, you can then exercise your option and buy the stock at $50, well below the market price, giving you a nice profit. However, if the stock price doesn't go up as you expected and instead stays the same or drops, you don't have to buy the stock. You would lose the premium you pay for the option, but you won't lose more than that. Put options, the right to sell. On the flip side, a put option gives you the right, but not the obligation, to sell a stock at the strike price before the option expires. You buy a put option if you believe the stock price is going to go down. For example, imagine you own a stock that's currently trading at $50, but you're worried the price will drop. You could buy a put option that allows you to sell the stock at $50, even if the price falls to $40. This acts like insurance, protecting you from a loss. If the stock does drop to $40, you can exercise your put option and sell at the higher $50 price, locking in a profit. If the stock price stays the same or increases, you simply let the option expire and lose the premium you paid for the option. The key terms you need to know. Now that you understand calls and puts, let's go over some essential terms that will come up for you trade options. 1. Strike price. This is the price at which you can buy or sell stock if you exercise the option. It's a crucial factor because it determines how much profit or loss you can make from the option. 2. Expiration date. Every option has an date, which is the last day you can exercise your option. If you don't act by this date, your option becomes worthless. 3. The premium is the price you pay to buy an option. Think of it as the cost of your bet that the stock will move in the direction you're for. The premium on several factors: how far the strike price is from the current stock price, how much time is left until expiration, and the volatility of the stock. 4. In the money, at money, and out of the money. These terms describe the profitability option. In the money, ITM. A call option is in the money if the stock is above the strike price. A put option is in the money if the stock price is below the price. At the money, ATM. The stock price is equal to the strike price. Out of OTM. A call option is out of the money if the stock price is below the price. A put option is out of the money if the price is above the strike price. How to trade options. Now that we've covered the base, talk about how to actually trade options. While it may sound intimidating at first, the process is fairly straightforward once you know what you're doing. Step 1. Open a brokerage account. The first thing you'll need to do is open a brokerage account that supports options trading. Many popular brokers offer options trading, so you'll have plenty of options to choose from. Once you open your account, you may need to request permission to trade options, as it involves higher risk than regular stock trading. Step 2. Choose your stock and decide on the type of option. Once you've got your account set up, it's time to pick a stock you want to trade options on. Do some research on the stock's price movement and market trends to decide whether a call or a put is the right choice for your strategy. For example, If you believe the stock is going to rise, you buy a call option. If you think it's going to drop, you go for a put option. Step 3. Select the expiration date and strike price. Next, you'll need to choose an expiration date for your option. Generally, options with longer expiration periods are more expensive because they have more time to become profitable, but they also give you more time for your prediction to come true. You'll also need to pick a strike price. This is the price at which you can buy or sell the stock. Make sure to choose one that aligns with your prediction. If you expect the stock to rise, you'll want to choose a strike price that's below the current market price, so your call option is in the money. Step 4. Buy the option. Once you've selected your option details, you'll place the order to buy the option. You'll pay the premium up front, which is your cost to enter the trade. Keep in mind that you can lose the entire premium if the option expires worthless, so it's important to manage your risk carefully. Step 5. Monitor the position and decide what to do. After buying the option, you'll need to monitor its performance. If the stock moves in your favor, the value of your option will increase. At this point, you can either exercise the option, buy or sell the stock at the strike price, or you can sell the option itself for a profit. If the stock doesn't move in the direction you anticipated, your option will lose value as it gets closer to expiration. You can either cut your losses and sell the option or let it expire worthless. Strategies for beginners. As a beginner, it's crucial to start with a simple strategy. Here are a few options and strategies that can help you get started. Covered call. This is a relatively safe strategy where you own the underlying stock and sell a call option on it. This strategy generates income from the option premium, but you might have to sell your stock if the option is exercised. Protective put. If you own a stock and are worried about a price drop, you can buy a put option as insurance. This strategy helps protect your investment if the stock price falls. Long call or put. This is the most straightforward option strategy where you buy a call or put option, depending on whether you think the stock will go up or down. It's simple, but it carries higher risks since you could lose the premium you paid if the stock doesn't move in the direction you anticipated. Risks of trading options. While options can offer high rewards, they also come with high risk. The biggest risk is that you can lose your entire investment if the option expires worthless. The premium you paid is the most you can lose, but it's still important to only trade options with money you're willing to lose. Another risk is that options are complex, and understanding how time decay and volatility affect options prices is essential for successful trading. You could buy an option thinking the stock will move in your favor, but if time runs out or the market doesn't move as expected, you could lose your premium. Final thoughts. Options trading isn't a get-rich-quick scheme, but with practice and knowledge, it can be a valuable tool in your investment arsenal. By understanding how calls and puts work, as well as the key terms and strategies, you'll be well on your way to making informed, calculated decisions when trading options. Remember to start small, be patient, and manage your risk carefully. With time, you'll gain the confidence you need to navigate the world of options trading like a pro. Whether you're in it to make a quick profit or as a way to hedge your portfolio, options offer endless possibilities. Ready to get started?